Yo, in this video I'm gonna go over why I believe we're in for a Great Depression, and I'm gonna cite many things, not just the charts, but it's gonna be fundamentals and numerous factors that will give validity to my thesis and strengthen my thesis. But I'm not trying to convince you of what I believe is going to happen. I'm just looking at historical probabilities and saying to myself, there's a lot of things that are pointing towards the same outcome here. I believe the outcome is very gloomy, and this is not just a fearmonger, but because of historical probabilities and facts. There is always a chance that this time is different, but as they say on Wall Street, the four most dangerous words in investing is this time is different. And I truly believe that. And I don't think this time will be different. So, behind here, we do have a picture of the Wall Street cheat sheet, which is a chart taken from the Cisco chart during the dot-com bubble, which is just showing the psychology of a market cycle. I've reduced the transparency here on this picture to have it behind the regular candles, which displays the chart of the XIC, the Nasdaq. And what's scary about this is that it's been following it almost perfectly since 2013. Actually, it's been 100% perfect pretty much, besides sure, it goes up a little bit here, but that's not the point. It's just meant to be a template, right? So, what I think is so fascinating about this chart is that I've been following it since last year, and it's still following it. This can deviate at any point, and it's not a lot to ask for. I'm not saying this will play out, but it has been playing out perfectly for 10 years. If this plays out, I want you to question everything you see in your life, in the media, and everything else going forward, because this is way too corrupt and way too planned in that case, okay? I don't care about the narrative. If we look at the charts and we look at what historical probabilities and data points towards, we can draw our own conclusions, okay? But this is just what the chart is showing we're in for in the future, unless it deviates, okay? Now, the reason why this can repeat so much is because markets are driven by human emotions. So why can't this play out the same way? Anyways, we're gonna go over to some other things in a sec regarding fundamentals and why I believe you can strengthen that thesis with historical probabilities and so on. This is the S&P 500. I'm just gonna go over the chart quite briefly. More zoomed in. This looks garbage, okay? Why? This yellow line is the 200-day moving average. It's the average price in the past 200 days. Why is that relevant to be above? Because there's a saying on Wall Street that goes like this: nothing good happens below the 200-day. Typically, in bull markets, you want to stay above the 200-day, and especially the 200-week. But when you start violating them, it's typically not a good sign. Now, that's just the moving average. But what we have here is, you see these highs here? That's supposed to be a floor in the future. Why? Because trap traders have tried to short sell here. They short sold here, and then it broke back above this level. When it comes back to backtest this level, it should see a bounce, which it did, right? Enough of the 200 and this upward sloping trend line with that low and that low pointing towards that low, okay? So confluence of support here. Horizontal level, diagonal upward sloping support line, and the 200-day. But what happens right here? We break below it. You can no longer make a bull case for this chart as of how it looks right now. Besides the fact that we do have bullish divergence. If this chart loads, you can open a new one. So what we have here is we have a lower low on the RSI compared to over here, whereas the price made a higher low compared to over here. What that means is that there's more people interested in selling, but price is unable to go lower, okay, compared to over here. Because this is taking volume and so into account, the RSI, the oscillator, right? So it's likely that we get the bounce at some point over here, but I wouldn't bet on it because a lot of people think like that and think there's going to be a bounce. And the Wall Street cheat sheet is telling us that we're pretty much just going to go down only. All right. Now, the reason why it's important to bounce here is because there was trapped traders around this level, but it wasn't able to sustain this level. And so now all the bullish things are getting invalidated, or well, I mean the bullish technicals are getting invalidated from a bullish point of view. Okay, now it's becoming resistance instead. So this is just the charts. Now we've gone over the XIC and the S&P 500. Now let's go over something specific here. Just one last thing before I conclude the charts. Notice where this level, where it's retraced back to as it recovered some of the losses, to the 0.702. Why is the 0.702 retracement important? Because it's in between the 0.618 and the 0.786. And you can add that to your retracement tool. Now, that level is important because what happens typically in uptrends for something like BTC? Twice. Well, we have a low, we have a high, we have a low. We have a higher high, a higher low. We have a higher high and a higher low. We have a higher high and then a lower low. So the uptrend is breaking. It recovers 70.2% of the losses. And then look what happens here with Ethereum. Ethereum in orange. From the day BTC tops out, look at this. 27 days from top to top. Okay? What happened in 2021? Same thing over here. We have a bunch of, we have a high, a higher low, a higher 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 high, a lower low breaks the uptrend and it recovers to the 0.702 retracement. From the day BTC tops out, how long does it take? 27 days for Ethereum to top out. So in both examples, it's 27 days after the same characteristics have been displayed in both examples. You see why there is some relevance to this level right here? Now, you see on the chart that I've gotten I have a couple of things written here. Fed got out of the market here for ethical reasons. Okay? What I mean by that? On October 21st, 2021, the Fed got out of the market for ethical reasons. The Fed no longer forecasts a recession, pretty much on the day that this tops. And what do I mean by that? Notice the date. The US Federal Reserve Chair Jerome Powell said on Wednesday that the central bank staff no longer forecast a US recession. That's weird. Right at the retracement. And then Congress is talking about getting out here for ethical reasons. What else do we have here? That's a little bit, how do I put this, strange? Well, JP Morgan CEO, Jamie Dimon, for the first time, is dumping JP Morgan shares. 1 million, in fact. So not only do we have the Fed getting out here for ethical reasons, the Fed no longer forecasting a recession at the top. And why is that important? Because it makes the noobs buy in when they're telling them that everything is safe. Congress talking about getting out, but also JP Morgan CEO, Jamie Dimon, selling shares for the first time ever. Why do you think he would do that? Just think about it logically. You think he's optimistic about the future? I don't think so, because it's the first time ever. And why is it right now? As we're seeing something here, which is really important. This is the yield curve. So what is the yield curve? The yield curve is simply this chart right here is comparing the 10-year yield versus 2-year yield. And it's subtracting the 10-year yield minus the 2-year yield. And you get the spread, the delta between the two in regards to interest rates difference. So as you can see here, the 2-year yield is 5.004 and the 10-year yield is 4.839. In a healthy economy, you would expect the 10-year yield to be higher than the 2-year yield. Why? Because obviously if you go and lend your money out to a friend, you'd want more interest for lending it out for a longer period of time. But currently that's not the case on an annualized basis. So you get a higher yield for lending it out for a short period of time than a longer period of time. That's typically not a good sign. And this has forecasted, or this has predicted every single recession since World War II with no errors. Every single time. 11 out of 11 times. As you can see here, and this chart only has data going back to over here. So what we have here is we have the inversion of the yield curve, which means that 6 to 24 months from this point, there will be a recession in the future. Okay? But it doesn't happen until it normally comes out of steepening, or it comes out of inversion and it re-steepens. Re-steepening meaning the interest rates normalize to the point where the long end of the curve will yield more again than the front end of the curve. Okay? So when it re-steepens here, normally it can happen through two different concepts. One called bull steepening, which is when the front end of the curve, the short end of the curve, is dropping at a quicker rate than the long end of the curve, normally because the bond market is signaling for the Fed to cut interest rates. And that normally happens not because they were trying to be nice, but because there's a recession around the corner or some sort of crisis. And the second thing is bear steepening. Bear steepening being when the long end of the curve is going up because there's inflationary expectations in the economy. Okay? So as you can see here, yield curve up, stock market in blue down, unemployment rate in orange up. Over here, inversion of the curve, re-steepening, stock market in blue down, unemployment rate up. What do we have here? A re-steepening, stock market down, unemployment rate up. A severe inversion. Look at the inversion before COVID. Inversion right here before the Great Financial Crisis, and the inversion here before the dot-com bubble. Anything below the green horizontal line is an inversion at 0.000%. Okay? Look at the severity of this inversion. Okay? It's down here. This was right before COVID. This is right before the GFC. This is right before the dot-com bubble. Inversion. Re-steepening. Stock market doesn't like it. What's going to happen to the unemployment rate? Most likely it's going to go up, which will make the stock market crash even harder. Because as people lose their jobs, it's going to cause forced selling. And that's normally when real estate crashes as well. Okay? It doesn't happen normally until people start losing their jobs. Alright? Now, what I want to go over is a couple of things. You don't think the Fed would do... A lot of people will argue that they think the Fed will do something, it will step in. But I beg to differ. And there's a couple of things here on federalreservehistory.org that says, or that implies rather, that you should take them not at face value, but you should look at what they typically do historically when they say something and it's completely different, right? Like reality turns out to be completely different. For an example, when they said inflation was transitory, it wasn't transitory. They're not stupid. They're just telling you that to not make you panic. People will say, okay, but they didn't plan inflation, right? Well, they did. Back in 2017, 2018, what did they say at FOMC meetings? We want inflation to run extra high for a prolonged period of time to make up for all of those years during quantitative easing 1, 2, and 3, where we failed to reach our 2% inflation target goal over time. How do you cause inflation? You screw up the supply chains, you shut down the global world economy, and you create more currency units chasing for your goods and services. There you have inflation. COVID was very convenient. I'm not saying anything about the virus because I'm not here to conspire. I'm just saying it was very convenient to have an excuse to quote-unquote print, which is just a simplified version of explaining all of the things they were doing. $5 trillion of monetary stimulus, $5 trillion of fiscal stimulus. Because people wouldn't have been fine with it if there wasn't a crisis. Now, the Fed did things that were completely illegal at the time. They're not allowed to, according to the law, they're not allowed to go in and buy corporate debt, but they did. Anyways, if we look at this article, regarding the Great Depression, we did it. We're very sorry. We won't do it again. It's a quote from November 8th, 2002. He was Fed chair. In a speech given at a conference to honor Milton Friedman on the occasion of his 90th birthday. We're going to get back to Milton Friedman in a sec. Couple of quotes. By the way, he said one thing which we're going to go over soon, which is the primary cause for the Great Depression was a contraction in the money supply. Guess what we have today? We have a contraction in the money supply. Look. Contraction money supply? Tell me when the black line has gone below zero, besides, oh, you guessed it, the Great Depression. Oh, and before that, another Great Depression. Oh, and before that, another Great Depression. Oh, and before that, another Great Depression. 1870s, 1893, 1921, 1929. 2023. Will this time be different? I doubt it. If the greatest economist of all time, which they are bowing down to, said that, there is probably some relevance to it. In 2002, Ben Bernanke, then a member of the Federal Reserve Board of Governors, acknowledged publicly what economists have long believed. The Federal Reserve's mistakes contributed to the worst economic disaster in American history. Alright. A lot of people are confused. Why hasn't everything crashed yet? Well, as Milton Friedman says, monetary and fiscal policy is rather like a water tap that you turn on now and that then only starts to run 6, 9, 12, 16 months from now. It is because of this long lag in reaction to policy that you tend to have this tendency for policy to in fact have an effect opposite to that intended, or again, thus you have a situation such that when the Federal Reserve System takes action today, the effect of that action may on some occasions be felt 5 months from now, on other occasions 10 months from now, on other occasions 2 years from now. That is the major reason why it is so difficult as a technical matter in the present state of our knowledge to know what measures one ought to take at any given time. What else do we have here? We have US Treasuries on track for their longest treasury losses since 1787. Alright, so we have a money supply contraction, we have a severely inverted yield curve, we have bond losses or US Treasuries on the track for the longest treasury losses since 1787. 236 years, by the way. And people aren't concerned yet? This is some serious stuff. Now, I want to go over something regarding BTC because we're going to go over charts here individually. And what I wanted to go over was this. Number one, I want to speculate a bit here on some technicals, because I don't believe that this is anything more than, and I'm not sitting here and trying to top call, I just personally don't believe, as of right now, I'm not saying you should believe me, I'm not saying that I will be right, I'm just saying, I don't believe that this is going to be a real breakout. Why? Because, pay attention to this. Okay, my pen doesn't work right now. Pay attention to that high, and that high, pointing towards that low. That low and that low, pointing towards that low, which led to capitulation once it broke, came back up, back tested it along with that low and that high, pointing towards that high. Now, I redrew this parallel channel because before I had it drawn something like this, and I'm not saying that this is how it should be drawn or anything here. I don't know why my chart isn't working. Let me reopen it. I'm not saying that the chart has to be drawn in a specific way. It's pure speculation, okay? So this is how I drawn it before, and you could see there was some resistance to this technical level before, because it was getting rejected right here, and then it broke above it, back tested it somewhat, and then it came back up here, right? So whether the trend, whether the parallel channel was going to look like that, or whether it was going to look something like this, which this actually has 3 touch points on the lower side. I don't know, but it's speculation, right? Along with the fact that this CME gap got filled, which we can see here. This is the CME gap. This is left behind liquidity right here. You see, this gap right here was perfectly filled to the dollar, right? On top of that, just like in the stock market, we have not seen total break out of this range. So no new money came into crypto in the past 6 months. In fact, as of right now, there's 2% less money in crypto than it was half a year ago. And there's only 4.5% more money in crypto than 14 months ago. So is it really a breakout for BTC that is supposed to be reliable and it's decoupling? Or is what's actually happening, just that money is getting drained from altcoins? something like Ethereum dropping 41%, or something like Litecoin down 60% since over there in November of last year. Because you gotta keep in mind, people are trading their altcoins for BTC and vice versa, right? Bitcoin maximalists, they don't save in USD or Euro. They save in BTC and they're just trying to maximize their BTC. But in this case, we can see that there's just been a clear liquidity rotation, right? People have just rotated out of their altcoins. So how can this be a sustained breakout? So it goes back to what I was talking about before with this 5-way count. And I'm not going to sit here and say that this should have been drawn on the total market cap. On the total market cap, it's still relevant actually, but it got invalidated on a BTC one. So it could look something like this, right? Whether you want to take it to that high or that high. But I'm not going to sit here and try and say that that's what's playing out right now, because it got invalidated on BTC, which is what I went with to begin with. Now, I want to present one argument here for BTC, which is this. When you look at this, you're going to say this is absolute insanity. This guy is just doing this for engagement. Really? What if I told you this guy is the guy that bought Ethereum on the day of the low and sold it on the day of the top? All based on mathematics. You don't believe me? I'm going to go over 3 examples. Listen to what it says.
Like that happening, it would be that we come up and we break the all-time highs, and like I've talked in my other videos, do this kind of double tap thing, come out, hit it, and then we just grow, and then slam into it, and then off we go. Now, what would that look like if we didn't have this on a log scale chart? It would look like that. And I can just tell you, from being a guy who has stared at millions of charts, it feels like, and spent countless hours staring at charts, does that look irrational to me? And it does not look irrational to me, because what we have is we have the big initial bubble collapsing, then we have the retrace and the consolidation, and then we go start our new cycle. And this far of an extension out up to about $73,000, $74,000 does not seem irrational to me. It seems completely normal.
Okay, that's example number 1. Let's go over this. Example number 2.
I expect, as we've talked about, I've been saying, I expect Bitcoin to go to probably around $80,000, right? So you kind of outline it like that, and right up here around 80K. Well, when we look at how NEO performed after this moment right here and put a Fibonacci on top of it, NEO went about the same distance, right? Which reached right up to the tip 4.236 Fibonacci extension level, and then that was the end of the cycle. And that's what I do expect for Bitcoin. And I know that's not a favorable thing to say, that I expect Bitcoin to have one more push up to the top, and then that's the end of Bitcoin. I mean, I could see after the next bull run, I could see Bitcoin coming all the way back down to 3,000. So we're talking like going to 80,000, then coming back to 3,000. I know, not favorable to say, but that's kind of what I'm seeing in everything after all the analysis that I've done. I try to shoot it straight with you guys.
Okay, and then the third example, which is this one. Listen to this.
There is a pretty decent chance, okay? A pretty decent chance that Bitcoin could crash all the way down to $2,000. Boom! Thumbs down mania on this video. Okay, I can't listen to this guy. He's crazy. But from a structural standpoint, it absolutely could. This could absolutely be the very end of a Bitcoin super cycle, especially if this is true for the Dow Jones Industrial Average. This was what happened in the 1920s for the Dow Jones. It went incredibly parabolic. It went monstrously parabolic. You can see how these levels down in here did get taken out in here. And Bitcoin has had the luxury of getting created at the very bottom of the great financial crisis and riding all the way up through a bull run and a bull run alone. And we do know that when this occurred, Bitcoin was massively affected by it. And it has been an up only market for the stock market the entire time. If there is a big massive deflation event that were to come to the stock market and to the housing market, it is certainly possible to go take out those price levels in here. And even as we saw in the 2017 bull market for Ethereum, that's precisely what it did. It reached all the way out to the 4.236 extension after a crash, retrace, reaccumulation, breakout to the 4.236, we can see how low Ethereum went after that time period. That was thought to be impossible. Ethereum going down to $80. It was at one point $1,400. It went all the way down to 80. Thought to be impossible. And as you can see for Bitcoin, you have crash, retrace, reaccumulation, breakout. If we get to just about here, the 4.236 extension, we just showed examples of it happening in the Dow Jones, that it definitely can go take out those lows. And we just saw it happen in Ethereum in the last bear market.
So when you look at this picture, you're going to say, this is impossible. Again, this is the guy who told you everything that was going to happen here. It perfectly happened. He 60x his money, bought the day of the low on Ethereum, sold the day off the top. I would say that's a pretty good track record, right? And he's been bullish the whole way up, but this is what he sees going into the future. So, just saying, should probably listen. Anyways, we're gonna go over two things here regarding this video, this documentary, which, by the way, for some strange reason, notice how it's unlisted. This means unlisted in Swedish. I don't know why that is. It's kind of weird. I don't know why they would unlist it, and it was like 2 months ago. Huh. 3 months ago, right when the stock market was talking. I'm not gonna get into conspiracies here. I'm just saying it's kind of weird. It's a pretty popular documentary, 17 million views, and it's just unlisted. It didn't make it private, didn't remove it, just unlisted it. Because I tried to find it in my browser and I noticed, what the fuck? It's actually unlisted. Anyways, let's listen to what the geniuses were saying.
The markets were affecting the real economy. The markets were closing down, people cutting back hiring, cutting back investing, cutting back spending to protect themselves, and you were looking at what looked like could be a Great Depression.
I described it as an economic Pearl Harbor. The 1929 panic was nothing.
Did you hear that? The greatest investor in our lifetime.
Like this. The system had stopped.
Alright, and here's the second example.
About halfway through the conversation, the president interrupted Hank and directed a question at Ben.
I asked, are we headed for a Great Depression? And Bernanke said, looks that way. And you have to make up your mind, Do you care? And what I cared about was people that would be hurting. They were already starting to hurt. People were getting run out of their homes. Payrolls couldn't be met. And I just could envision what a Great Depression would mean. If it's bad now, imagine how bad it would really get.
Alright, so now I presented my arguments for why I think it's gonna happen. Now, when is the bottom gonna come in? I might have made some errors when it comes to drawing this. Again, it's not a perfect replica with the way I put it, but you can see how the charts look extremely similar. So after the yield conversion, which is the most flawless economic indicator in human history, and it's a leading economic indicator, after the 10-year 3-month inverts, you can see this is the path to trough, 31 months out. It inverted in October of 2022, the 10-year 3-month. So that means the recession comes 6 to 24 months later, but the bottom in the stock market can come up to 31 months later based on the dot-com bubble, which is the dark blue line, and the GFC, the Great Financial Crisis, or the Global Financial Crisis, which is the green line. 31 months out from October 2022 puts you around May of 2025. That's around where we are over here. Adjusted for any sort of errors that I've had when overlaying this chart on top of the XIC. This is why I believe we're going to have a Great Depression. I have put tens of thousands of hours into this, trying to come up with why I believe all of these things are going to happen. On top of that, the stock market is up at the 4.236 extension, in between the 3618 and the 4.236. You might say, what does that matter? I don't care about your indicator on your chart. It doesn't mean anything to me. And that's reasonable, if you don't understand it. Let's go over something. I don't know why my chart does this. if we go back to 1987, something strange occurred here. Let me remove this. If we take this Fibonacci retracement tool and we drag it from the 1973 top to the 1974 lows, when we got up to the 4.236 extension, the stock market sold off. You're gonna say this is anecdotal evidence. Sure, right now. But the thing that's important about this chart is that there's clearly some validity to it, which with what I'm going to show you soon with all of the examples, which makes it not anecdotal evidence, which is that when the chart looks like this, the algorithms, which accounts for 43% of all trading in the stock market and in crypto, when the price goes up, they don't know where to sell, so they sell at the 4.236 extension. And the example of this, multiple examples, is when did the S&P 500 hit its 4.236 extension? From the 2007 highs to the 2009 lows, it hit its 4.236 extension. Let's look at when it actually broke through it. It was right here, around this week, on the 18th of October 2021. And what did I go over regarding when they got out of the markets? October 21st, 2021. That's right as the Dow Jones, the S&P 500 is struggling here at the 4.236 extension. Where is it rejecting more or less now? At the 4.236 extension on this dead cat bounce, which is what I believe this is. But you're gonna say, yeah, but that doesn't mean anything, because you just show me two examples of where the stock market tops out like that. Okay, what about this? High to the low, 4.236 extension. Isn't that what this guy was talking about over here? All the way from the bottom? That's weird. Well, what about Ethereum? Could Ethereum have seen Ethereum's top as well based on that? The high to the low, yes, it perfectly predicted the top too. What about the total crypto market cap? Oh, that too. See that? The high to the low, 4.236. Then you're gonna say, okay, but you've still only provided a couple examples. We need more. We need way more. Alright, sure. What happened during the Great Depression? Now you're gonna say, there was no TA that was relevant back here. Alright, and what is TA? It's just technical analysis, right? Reading charts. That low and that low points towards the next low. That low, that low, that low points towards this low. Confluence of two trend lines connecting. How much did the stock market bounce? 113%. That high and that high pointed towards that low and that low with slight deviations. Taking the 1 to the 0, okay? Where did the stock market top out briefly? 4.236 extension in 1928. Notice where the RSI takes volume into account. Notice where that topped out. Right there. As the Dow Jones hit the 4.236 extension in 1928. So this is 90 years ago. 95 years ago. Notice where the Dow Jones was finding support. At the 4.236 extension. Where did it get rejected? At the 4.236 extension, the rebound. You don't believe that technicals worked back then? Okay, let's look at it. Look at this trend line. These two lows points towards that bounce area with a slight deviation because there's so many liquidations here. You see it's holding these lows, bounces off of it until it takes out that level. And now where does it go to? It goes to that low pointing towards that low, which points towards a 27% bounce. And then the horizontal level from 1919, 31% bounce. And now what do we have? We have the legendary trend line, which led to the bounce. Okay, that low, that low, that low, and that low, pointing towards the next low, which was a 39% bounce area. What held down the stock market the whole time? One trend line. This trend line, the whole way down. So you can sit there and say that, oh, technicals didn't work 100 years ago. Well, clearly they did. And all this is telling you is, as price goes higher, there is a divergence with RSI, right? Price making higher highs, RSI is making lower highs. What does that tell you? There's fewer and fewer people interested in buying. As price goes up, you can see this here. Therefore, it's probably not a trustable move. And what are some similarities over here? We had a virus here in 1918, 1920. Exactly 100 years later, we get COVID. Notice how this structure looks the same as the stock market today. And what do I mean by that? Well, just look at this. What do we have here? We have a high, a higher high, a low, and a lower low. Okay? We have a high, a higher high, a low, a lower low. A virus which led to a credit bubble. Exactly 100 years later, we have a virus. Not at this point, but it led to a credit bubble. A quote from the Great Depression. The 1920s was all about excess. Folks too free with the credit and speculation. Too much inflation and debt. Too much cash, then too little. All of these things point towards a massive collapse in the stock market. And people who say that just buy and hold. The stock market didn't move anywhere for 35 years. For you to make your money back, it took 25, 26 years. Adjusted for inflation, 33 years. But it's not just that, right? You can also look at it on the Nikkei. This is the Japanese stock market index. What has happened over here? People will say, oh, but the Fed will come to rescue this, that. Well, let's look at the facts. This stock market index here, the Japanese stock market index, the Nikkei, topped out in early 1990. Still hasn't reached new highs, even 33 years later. Do you know how much the money supply is up? So the stock market is still not back to new all-time highs, even though since it topped here, the money supply is up 167%. The money supply from the peak to the bottom was up 46%, but the market still kept going down. Bank of Japan called QE ineffective because they tried it over here in March of 2001, but the market still fell another 40%. And then even made a new low in 2009. So a 167% increase in the money supply. The stock market still didn't make a new high 33 years later. And it's probably about to collapse again with the rest of the markets. So do you really think that the Fed is going to come to the rescue and they're going to solve all your problems? When in fact, these psychopaths are probably planning all of this. And if you think that's me conspiring, again, does this not look a little bit planned to you? Maybe not, right? Just saying though, it's a very weird coincidence, okay? And maybe it doesn't matter that US Treasuries are on track for their longest Treasury losses since 1787, even though the whole global financial system is built upon everything that has to do with the Treasury market. If it's illiquid and fragile like this, it's probably not good for the rest of the markets, okay? This time is likely not different. This is going to lead to a lot of pain, but also great opportunities. That's all. Peace.